Good evening, everyone. This is Tyler Daigler, Marshall Reddick Real Estate. Thank you so much for coming tonight. We're going to give it just a minute for people still coming into the room, and then we'll get started. All right, everybody, good evening. Thank you so much for coming to our presentation tonight on multi-unit investing in Southern California. My name is Tyler Daigler. I'm excited to speak with everybody tonight. So today we're going to be talking about multifamily investing as a part of your portfolio. The point of this presentation is to sell you on multi-investing being for you, but more to talk about what multi-unit investing is, how we help our investors profit and grow their net worth with multi-investing. We're going to dive into the math a little bit, and then I'm going to answer some questions. I talked to a number of you before we started this evening, so I've got some of your questions, but if anybody has any other questions while I'm speaking, please feel free just to type them in, and I will get to as many of them as I can at the end of the presentation. So nice to meet you guys. Again, my name is Tyler Daigler. I've been in real estate since 2017. I went to Clarkson University for financial information and analysis, and just recently finished my negotiation mastery program at Harvard. I've helped over 50 investors acquire properties just like what we're speaking about tonight. I've closed real estate in over 13 states now. And I just like to highlight I have 103 five-star reviews at this point from investors just like you who I helped accomplish the same that you're looking to accomplish this evening. And I was recently featured on the Icons Real Estate podcast talking about real estate reviews and the positive impact that it has on your business. A little bit about Marshall Reddick. We have 4 divisions within our company. Our first division is real estate brokerage. We help people buy and sell their homes as well as buy and sell investment properties. Our second division is property management. We also manage real estate. We take care of everything from landlord to leasing, maintenance, renovations, rent collections, etc. So all of our landlords need to do is collect their rent check every single month. We currently manage just under 3,000 investment properties for our clients. Our third division is private lending. We provide non-owner occupied real estate loans to borrowers, typically doing fix and flips, new construction, and purchase new investing properties. And then our fourth division is mortgage investing. The same way you can own real estate and collect rent checks, our investors own mortgages and collect mortgage payments. So we've got a number of ways that our investors like you can invest in real estate. Tonight, we're going to be speaking about just one of those in multi-unit investing. So what are we going to cover tonight? We're going to talk about why multifamily and why it would or may not make sense for your portfolio. We're going to talk about cap rate, and then we're going to talk about value add, which is a really fun strategy for growing values in multifamily that is pretty much only found in multifamily here these days. We're going to talk about buyer and seller representation, talk about what we do to find properties like this. We're going to briefly go over our property management and financing, and then we're going to do some case studies on some properties that we currently manage and some properties that we're currently doing value add projects on. All you guys need to do is sit back, relax, and learn. Feel free to ask questions, engage with each other if you have any questions or you guys want to do a little bit of networking. And if you have any in-depth questions, please feel free to write them down. I'm going to be giving everybody a call after the event in the upcoming week to see if there's anything that needs clarification left. So a little bit about our markets. We have offices in Orange County and LA. We also have offices in Central Texas, in the Nashville, Tennessee area, and then in the Cape Coral, Naples, Florida area. And then these are other states that we also do business in. The states I just mentioned are the ones where we have a physical footprint and property management teams. So before we get into all of this, I just want to touch a little bit on the market here in Orange County, LA. And the last several weeks have been pretty indicative of what we think is going to be happening here. So this chart right here is Orange County demand year over year. And what demand stands for are properties being put into escrow. And if we start here with 2019, this is before the pandemic hit, you see a very common trend line in human behavior in these markets. As we come out of the holidays, demand is low, but then we start going into the spring, more and more transactions go under, starts leveling out in the summer, and then starts dipping down in the holiday season. This is the typical trend that we see each and every year here in Orange County. Coming into 2020, it started off very normal, and then boom, you see this massive drop. This is when the pandemic hits. This is when everyone was staying home, not buying houses, trying to figure out what's going on and what's going to be happening in the world. Just an absolute drop in demand. And then we come into April and May, and this is when the Fed dropped the rate to 0. And all of a sudden, everyone in Orange County could afford to buy. With the Fed dropping to 0, mortgage rates, as you guys remember, are in the high 2s and the low 3s. And at price points like we experience here in Orange County, it made a huge, dramatic impact on affordability. And all of a sudden, you see demand just skyrocket, shoot straight up into higher demand. More deals were happening than ever before. Then coming in here to 2021, you can see we're back to that normal human behavior, though you'll notice that the number of transactions happening were higher. Everyone was gobbling up all the inventory because it was more affordable, but the year still acted very normal. 2022, we find our massive rate hikes. Inflation has become a public issue, and the Fed is raising rates, and at one point we hit in the low 7s. And you can see that human behavior was still acting exactly the same. You know, slower in the spring, starts coming up as we get into late spring, then tapering off through the year. Though you'll notice on the number of transactions, it was ultra low. You guys remember last year and the year before, inventory was so incredibly anemic. Multiple offers on all properties, things selling for way over ask. But the human behavior and in the trend line of how people and when people were buying still remained very normal, just at a lower rates. And then we come into this year. Coming into this year, buyers have been very hesitant. The rates have been high. There have been affordability issues. Everyone's quote unquote waiting for the market to drop out. Yet in the last few weeks, as people have started to come to terms with rates, and the rates have actually gotten a little better here a little bit in the last few weeks, you notice demand has started spiking. We're experiencing a massive increase here in the number of deals happening in Orange County and LA. Over the past 3 weeks, new mortgages are up 38%. And then we're going to look at days on market. Our days on market is dropping. You can see here that we started generally about 80 days on market. That's the time from putting the sign in the lawn to going into escrow. It had been taking about 80 days, which was a lot slower than it had been over the previous few years because of this lack of demand because of high interest rates. Yet over the past few weeks, you can see these days on market are dropping dramatically. We're now down to about 51 days. So the time on market has dropped by about 30%. And this is indicative of what we're going to be seeing throughout the year as rates level off, people start digesting, and people realize that there's good deals to be had right now because of the low demand. People are starting to pick up properties. So we're in a market that's been cooling over the last 6 months. There's been low real estate activity level, especially on the primary side. Investors have been coming in and gobbling up inventory and kind of keeping the market afloat. But now that people are starting to become more familiar and more relaxed and understanding of the market we're in, people are starting to buy up and the market is starting to heat back up. I just wanted you guys to have kind of updated over the last few weeks of what we're seeing here over the many transactions that we've been handling. So let's dive in to what we came here to learn about tonight. Why multifamily and why value add? So in multifamily, you have the economies of scale, multiple doors and multiple rents. This really helps cut down on liability versus a single family home when you only have one renter in there. Between turn times, when that person moves out and you're getting the property ready again and re-rented, which is taking about 30 days on average right now, though that number is starting to steadily drop, you experience a full 100% vacancy versus with the multifamily. As you're turning one door, you have other doors that continue to pay at that mortgage, at that principal and the interest and the taxes. So it really helps kind of lower cash flow liability and your price per door goes down. So a lot of investors, when they're looking at a portfolio of multiple properties, they're doing their numbers based off the number of doors, the price per door, income per door, liability per door, so on and so forth. The more doors you have, those numbers start looking more favorable. There's also less competition. Your average real estate investor is purchasing single family homes, 3-bed, 2-bath, 2-car garage with a fenced yard. Less people are getting into multifamily just because there's more to understand. It's a more advanced investment, and it often requires higher capital. So there's less competition, so that's very advantageous. And then forced appreciation, where this is the value add. Unlike a single family home, which is value based off comps in the area and amenities of the home, multifamily homes are value based off their income. And when there are multifamily homes where the income can be dramatically reduced with just a little bit of strategic work, you can force appreciation in the values of those properties. And that's one of the key things with multi-investing is you can really create rather quick equity gain that you can then access through cash out refis for free. There is no tax on that debt. So it allows a really fun way to scale. And speaking of economy of scales, here's just a quick example. If we were looking at a $750,000 fourplex, the price per door is $187,500, right? And you get that general income of about $8,000 and you have one property to maintain. Now, if you look at a single family home, in this example, $250,000, one door, your price per door is at $250,000, and you have the monthly gross income of $2,250. But 250 times 3 is going to bring you up to that 750. So yet it would take 3.5, just over 3.5 of those properties to produce the same income. So you can see that multiplier in the economy of scale. So that's one reason that our investors will go towards multifamily, is because of that income multiplier. Cap rate. So when you are searching for multifamily investments trade on what's called a cap rate. And your cap rate is determined by dividing your net operating income by the purchase price. All areas in the Orange County and LA market trade at different cap rates. The cap rates in Anaheim are different than the cap rates in Laguna, are different than the cap rates in La Habra. And so using this formula, you can figure out, based on what a property is bringing in income, what it should be valued at. And you can do a reversion on that to find when you're shopping in a particular market, once you figure out what average cap rates are in that market, you can then compare that to the income on those properties to get an estimated value. This is a really fun way when you're shopping for multifamily, because unlike single family, where you're going to be comparing to other homes on the street, in multifamily, you're looking just at the numbers. So using this calculation, you can go online and you can find properties that are overvalued or undervalued. And this is a great way to approach the market when you're looking for equity gain. So cap rate reversion. Again, this is just what we spoke about, and we're going to go through an example on how using this technique can build equity. And for this example, we're going to assume that the neighborhood that we're working in trades on average at a 6% cap. And again, guys, there's a lot that we're going over tonight. Any questions you have, please feel free to enter them, or also just write them down. And then when I give you a call later, we can dive in deeper. So looking at this property right here, okay, this is a 3-unit that's bringing in $35,400. We assume on average an 8% vacancy. That number comes from being in business 50 years and aggregating a ton of data and computing that data over time. We can come up with average vacancies in different neighborhoods for different sorts of investments. So in this example, we're assuming an 8% vacancy. So you have your gross income, and then you have all your operating expenses. When you total it all out, you have your net operating income of $20,275. And then knowing that in this market, these properties trade at approximately a 6 cap, we're able to put a value on this property. And I will make sure that I send this to all of you after the webinar as well, so that you can go back and access this and create your own examples and run your own numbers. This is just a high level way of looking at this again on how we get to this value. So let's look at an example of how we can create equity with value add, right? So we're looking here at building B, right? We know after looking around in the neighborhood at what people are getting for rents and what the cap rates are, that this building could trade at a 6. However, it's currently trading at a 4. The reason for this is typically these buildings are going to be a bit dilapidated. They're going to need some new flooring, some new paints, pop in some recessed lighting, very, very basic stuff. But with a small investment and a small upgrade, you can up the rents, bring that to a more normal cap rate, and then force appreciation on that building. And you can do it in a relatively low amount of time if you plan it out correctly. So let's see what that looks like. So looking at this building here, this is an example of a building that we did. We picked this property up at 337,917, right? We held this for about 6 months. And basically what our investor did was they put 20% down on the property, and then they financed through us $20,000 in renovation budget. Again, this was a 6-month project. I'm going to show you some pictures and examples later on of how we do this. But after fine-tuning the property and bringing it to where it should have been, we're able to raise the rents up enough to bring it to a 6 cap and then sell this property for $492,000. So after all expenses, total cash in was about $77,000, and our investor profited just under $42,000 on that in just 6 months. And this is something that we do for a lot of our multi-investors all the time. Again, I will send you an example of the sheet so you can use this tool for yourself, but this is how that's done. Because the value of the property is based on the income the property produces, by finding properties with a little bit of fine tuning, being able to raise those rates, it force appreciates the value of that building, providing to you profit. I'm going to touch base real quick on just some lending options. So rates have obviously been the talk of the town, and they've dramatically impact returns on investments. And so we have a couple options available to our investors. The first is our private lending. We do in-house lending here, and we will lend up to 90% of the acquisition and reno budget on that property. So let's say that you guys are out there and you come across a property that you think would be a good project, a good value add investment. You can contact us and we're going to provide you an info sheet for you to fill out. We're going to talk about the value of the property now, why it's worth that now, what it's going to be worth in the future, why you believe it's going to be worth that, what kind of renovations you're going to need, what the cost is going to be, what the timeline is. And then we have an entire team of underwriters here. They're W-2 employees, and all they do are underwrite investment loans like this. So at the very least, this is a really cool way for you to get an absolutely free analysis on your investment, right? And then we'll talk about rates and what it would look like if you borrow the money from us. So that's a really great and free service option for you guys. And we'll, like I said, we will fund everything from acquisition, down payment, renovation, everything. All we ask is that you're 10% in the game. And you'll know really quick after we go through this underwriting, loan to value, and if we believe that it's a good investment for you. And again, just a little bit on us. It is asset-based financing, so it has nothing to do with your income whatsoever. It's perfect for 4 units it up in complicated files, reasonable fees and interest rates, and we can close really, really quick. We also have conventional loans, 30-year fixed loans. This right here is the maximum baseline loan amount for 2023. They just raised this. And the column on the left, this is for 1 units, duplexes, triplexes, and quads. That's the US average of what they're giving for loans on these projects. But on the right, these are high cost areas like LA and Orange County. And so what this means is, just for example, looking at a 4-plex, you can now get a loan up to just about 2.8 million with 25% down. So they've raised those numbers, which has been very helpful due to the cost of LA and Orange County, continuing to be on the rise. And this is Reed Hazard. He runs our conventional loan program here at Marshall Reddick. Again, I will get his contact information out to all you guys, but here it is again in case you want to have a consultation with him, and he will go through the exact same stuff with you. You can bring to him the kind of investment you're looking at, what you're looking to do, what you're looking to achieve. He'll help you crunch and run those numbers to figure out if it's feasible and a good investment. And you know, whether you go private or you go with Reed, we will never lead you into an investment that we don't think is a good one, because at the end of the day, if you default on that investment, we're going to take that investment and we're going to finish it out. So we're only gonna fund stuff that the numbers make sense. And then, so again, really cool free service for you guys, because it takes the guesswork out of it for you. If you come across properties, you can bring them to us. We'll run those numbers for you and give you a real idea on if that's a good investment or not. So just wanted to touch on that with you. So let's talk a little bit about our growing portfolio. Again, we manage just under 3,000 units across all of our markets. About 600 of those are in the LA and Orange County area. We have separate teams for tenants, separate teams for landlords, and separate teams for maintenance. And after doing this over 50 years, we've really been able to dial in how these investments work. And that's a really great resource for you guys, because again, it's going to take that it's going to take that question out of it. Right, so let's go over some examples. Here's a 5-unit that we've got under management in Santa Monica. It's got 1 3-2 and 4 2-2s. So since we've taken this under management, 3 of the 5 units have turned. During that time, we managed upgrades of about $200,000 for our clients, and it resulted in really big rent increases, which has really pushed up the value of this property. Another example of one that we've got is this 4-unit in Costa Mesa. Same thing. These are 2 1s. It was a recent value add acquisition. We took over the property. We helped a client get the renters out. We went through a renovation, bumped up those values dramatically. Now our client has a ton of forced appreciation under their belts. And here's one more. This is an 8-unit we have in LA. Half of these have turned, and as they've turned, we've put about $100,000 in upgrades into the building, again, forcing a bunch of appreciation for our clients. So a lot of experience doing just this. And again, here's just a touch on our property management. There's a lot here, but on a very high level, again, just about 3,000 units under management. We have very straightforward fees. Pricing wise, we're about in the middle. We're not the cheapest, we're not the most expensive, but we provide really incredible customer service. If any of you have the opportunity to Google us, Yelp us, Zillow us, you'll see hundreds and hundreds of 5-star reviews from our landlords who we've taken absolutely incredible care of, and they wouldn't work with anybody else. Again, I can send all this information to you, but what makes the Marshall Reddick program so great is it allows people to be real estate investors and not have to be landlords. For those of you on the phone that are landlords, you know what I'm talking about. It's certainly not the most fun job in the world. I've managed my own properties before too. And going under professional property management and no longer having to receive phone calls about clogged toilets and things of that nature it's an absolute blessing. It allows you to focus on your family, your life, your career, yet still grow your net worth through real estate investing. So property management's absolutely key. We always say you date your realtor, but you marry your property manager. You know, you buy a property with a real estate agent, and once it's over, you rarely hear back from them, but your property manager you're speaking with on a weekly basis as we're running your properties for you. So it's really, really important to get a good property manager. It can make or break your experience. This is just a touch on the market as we're seeing it right now. So for those of you who haven't read the Marshall Reddick Property Classing book, it's a book that we wrote a number of years ago, and it is an absolute staple in the investing community. And what it does is it looks at metropolitan statistical area pricing of home. And then after collecting data over 50 years, we've been able to show that certain pricing classes provide certain tenant and landlord experiences. And depending on if you're looking for cash flow versus appreciation, you're looking for good tenants or tenants that need a lot of hand-holding, you can use this book and the classing system to really get a good scope and forecast on what your experience is going to be like. If anyone wants a copy of that book, please just shoot it into the question box here, and I'll make sure that I send you over a copy. It's about 48 pages. It's a super light read, but it is a critical and absolute awesome place to start if you're new to investing, to get a lot of education on classing. But looking at Orange County and LA and 3 to 8 units in the A to B class markets, these are the typical price points that we're transacting on, right? And when you look at the expected cap rates, again, these are averages. Every city is going to act differently, but for stabilized performing assets in Orange County, you should be trading at a 3 to 4.5, and in LA, a 3 to 5. Right? So that's a really important key for you to know when you are valuing possible investment opportunities. Let's go over some examples of some projects we're working on right now so you guys can see this in action. And it looks like we're about halfway through. This was scheduled for an hour, but we're almost at the end. So I'm going to save you guys about 25 minutes of your night back. So here's an investment that we did in Torrance. We picked this up for 165, right? And the rents were bringing in about 77 grand a month. This was operating at a 1.9. The reason was it needed just some basic updates. And so that's what we did. We purchased this property. Here we go. And we started doing some light renovations. We put in some vinyl flooring, repainted, scraped the ceilings, put in some new lighting, and that was it. The kitchen, the bathrooms, everything else was just fine. We just light renovations on this property. Cost us about $120,000, right? After the rents, we were able to get up to almost $138,000 and get this up to a 4.7 cap. So where we started at a 1.9 and a value of 165, after these renovations at the 3.8 cap, this was now worth just over $2 million, right? So this is $247,000 equity gain in a rather short amount of time. And in reality, this thing ended up trading at a 5.91, right? And so $762,000 in equity gain was realized with $120,000 in upgrades. This is just an example of forced appreciation through value add in multifamily, because again, values are based on income. Here's another example, and we still manage this property today. We helped an investor pick this up for 1.8, and with their rents of just over $86,000, it was trading at a 206, much below that 3 to 4.5 that Orange County is known for. Again, just some basic updates, right? So as you can see here, right, this was a 4-plex, and since picking it up, 2 of the units vacated. In 6 months, we did a full renovation, right? So this one, we did some new kitchen, we did some new flooring, we put recessed lighting in it, right? We handled the evictions, we handled the renovations, everything was put together and run by us for our clients. $75,000 to handle that project. Afterwards, we got rents up to $130,000. And at a cap rate of 4.17, or it was operating at a 4.17, I apologize, valuing it at an average low of 3.5, the value of this property was forced up to 2.147, providing $347,000 in equity gain. These are just a few examples of the work that we do for clients looking to create net worth growth and equity through value add in multifamily specifically. So that's what makes this class of property investing possibly advantageous for you. It does require more capital and it does require some more work, but the equity gain in such a short period is what draws people to this sort of investing. And this is really what sets the multifamily investing apart in Southern California. So how do we do this? So unlike shopping for single family homes, where we don't normally require people to sell a representation agreement with us, it's much different in the multifamily and investing. There's a lot of investors out there, and a lot of these properties are not actively marketed. A lot of what we do is we go through your goals and what you're trying to achieve. We look at the capital that you have, and we break down what kind of investment criteria, price point, and area work for you. And then we go out and we contact the owners of these properties and we find a property for you. It's very work intensive and time intensive. So we do require that if you want to hire us to do this, that you do sign an agreement with us. We're going to do a one-on-one consultation. You're more than welcome to come to our office here in Newport Beach, or we can have an agent more local to you come and meet you to go over the steps. We can always do a one-on-one online. We can do a Zoom as well, or a FaceTime, whatever's easiest and most comfortable for you. We're going to dive into, again, where you're at, what you're trying to accomplish, your timelines, the capital that you can use, so on and so forth. And we're really going to build a strategy tailored around where you're at and what you're trying to do. Multifamily does require some speed. The reason for this is, again, we're typically acquiring properties that are off market. These are owners that have owned the properties for a number of years, and after we're talking to them and bringing them some offers, you know, they finally decided, okay, we're gonna let it go. As soon as that happens, they start calling their friends, their family, other agents, because they've now decided they've ripped the Band-Aid off, they're going to let it go. So it's important that we're able to move fast when we identify opportunities so that we can make sure we lock them up for you before they go to market, and then I'm losing a bunch of that return. Yep, and I just went over all that, and just some of the ways that we're finding our off-market deals. So we do direct mail. Once we identify the parameters in which the investment would work for you, we're going to put together a list of properties that we think are going to work, and we're going to start calling those owners. We're going to start mailing those owners. We're going to get in front of them and really start negotiating and building a deal for you. And again, after managing nearly 3,000 properties, we have an extensive network of owners, realtors, wholesalers, fix and flippers, you name it, that we work with on a daily basis. A lot of the guys that you're seeing on HGTV that are flipping homes around here, we finance their deals for them and ultimately end up managing a lot of them as well. So we have a really great network for finding stuff that's not on the MLS, and that's super key in this market. So these are a couple questions that I got from you guys when I called earlier. And so I just wanted to go over them so I can make sure you get those answers. So you already own a multifamily and you self-manage. Can we help? We absolutely can. It involves us having an interview and a conversation about the property. We're going to come see the property, walk the property, make sure it's something that fits within our parameters of what we manage. But we're absolutely open to helping you guys with that, and we can talk about that later. There's a lot of fears about rent control, and is multifamily safe? Different areas of LA and Orange County experience different rent control laws, and we're going to dive into that when we're looking at investments for you. We're going to make sure that we're not recommending places where you're not going to have the freedom to grow. And so it's key that you're working with somebody who understands how each of those counties and cities operates, so that you don't end up investing somewhere where you're going to have limited returns. One of you said that you were thinking about a 1031 and you were wondering if you can exchange a single family into a multifamily. You absolutely can. For those of you unfamiliar with a 1031 exchange is a program that allows you to sell an investment property and move the capital gains and debt into another investment property and defer your capital gains taxes. When you're looking at properties between 1 and 2 million, if you've held them for a number of years, your capital gains tax is going to be significant. Often it's going to be the down payment on another property. So instead of selling and paying capital gains and then working with diminished returns, you can roll all of that into a new property and not have to pay those capital gains. Our theory here is that you should never pay capital gains tax on your real estate investments. You should continue 1031ing and rolling into bigger and better investments, and investments that make more sense for you as your life goes on. And then when you pass and you leave your properties to your children, as long as they continue to do the same 1031 process, they will not be having to pay the taxes either. So you should never pay those. And then one of you, a few of you said you're concerned with the market's current status and should I wait to buy? The reality is that for the first time in years, we're starting to get deals for investors. You know, over the past couple of years with these low rates, this high demand, the low inventory, multiple offers were the norm. I'd put a property for sale Thursday, show it Friday, Saturday, and Sunday. I'd be going over 30 to 40 offers on Monday, sending out multiple counters Tuesday, be in escrow by Wednesday. It's no longer happening, at least at this moment, due to the drop in demand due to high rates. And for the first time in years, we're starting to get deals for our investors. In the new build space, we're getting appliances, we're getting blinds, we're getting upgraded furnishings, we're getting rate buy down. A lot of our new builders are paying for closing costs. And on the resale side, same things happening. We're getting a lot of seller concessions. Most of the properties that I've acquired over the last 4 weeks, I've been able to get an average of $10,000 in seller concessions. And we've used this to either cover closing costs or buy down interest rates to help with cash flow until the next refi opportunity happens. So it's actually an incredible time to buy. You're going to get a property at a lower price point and a lower tax base. Then when the rates come back, you refi and you strengthen your position. Like I said earlier, that is starting to change a little bit. Demand is up 38% in the last few weeks. More and more escrows are opening, and my belief is that as we go through the year here, I believe by fall we're going to start seeing appreciation again in the Orange County market. There's definitely other markets that are not feeling the same. Austin, for example, we have an office out there. And while Austin was the biggest winner in this COVID boom, they've also been the biggest loser. They were up about 100% year over year, and now they're down about 50. They're still up 50, but they're still down 50. Here in Orange County, LA, we have seen some slight price dropping to the tune of about 1.1%. But that 1.1% has really opened up opportunities for investors. So if you can buy now and weather the storm of higher interest rates for the next 6 to 12 months, there's a ton of advantage in doing that. If you guys have not been to our website, if you go under the Learn section, you can literally get a free MBA in real estate investing here. We have thousands of hours of recorded seminars, webinars, strategic discussions, so on and so forth, and hundreds of thousands of pages of text on all the same. And we've written it all ourselves. Nothing on here is copy and pasted from anywhere else. This is all self-produced over decades and decades of doing this. And if there's anything you guys want to learn about, you can simply go into that Learn section and search about it in that search bar. And you're going to find a lot of information on what you're looking for, and it's absolutely free. Unlike a lot of our competitors that do this, there's nothing to sign up for. There's no subscription. There's no $25,000 to join and then you get access. Our stance has always been to go to market with the absolute best and free education possible. So I want to make sure that you guys know that that's there. We spend a lot of time and money making sure that that free education is available to you. And lastly, the next step is a consultation with me. We can have a phone call, FaceTime, Zoom call. If you're local, you can come here to our Newport Beach office. I'll introduce you to our teams here and we can sit down and go over your situation, figure out exactly what it is you're trying to accomplish. Maybe multifamily is not the right investment. Maybe it is. Maybe you have different time frames, different goals, different capital allowances that might make certain investments work while others won't. We'll dive into all of that together, really dig deep and come up with a strategy that works for you. And once we figure that out, then I can act as a quarterback to get you in touch with the right people at this organization to help you accomplish those goals. Guys, I really appreciate you. Thank you so much for coming here this evening. I appreciate your time. There's a lot of things you could be doing at dinner time here on a Tuesday, so I appreciate you spending your time with me. Again, I'm going to reach out to everybody after this call later in this week, early next week, see what you thought, see if you have any questions remaining, anything I could clarify. And if you're interested in moving forward and seeing what Marshall Reddick can do for your net worth. I really look forward to speaking with everybody. Thank you again and have an absolutely incredible night.